I would like to hand over the stage to him. Let's have a great learning.
Today's topic is on transfer pricing. These are some of the contents I am going to cover. What is transfer pricing, its objectives, associated enterprises, international transaction, arm length principle, methods for determining the arm length principle, primary adjustments and secondary adjustments. Before getting on to the transfer pricing topic, let us understand with the case law. Here, there is a transaction between an Indian company and foreign company. Indian company purchases the product for rupees 30 and sells it to foreign company at rupees 50. The profit earned is here 20, and the foreign company sells the goods further for 70 rupees. Here, the profit earned by foreign country is 20. Suppose the tax rate Indian company is 30%, so 6 rupees will be the tax given to the government. In foreign country, suppose the tax rate is 10%, then the tax given to the government will be 2. But similarly, if the transaction between these two is of associated enterprise, here the Indian company purchases it for 30, sells it at 40 rupees. Here the concept is that selling more in the tax country and less in the higher tax rate countries. So profit declared here is 10 rupees and here is 30. So this is how tax was being reduced. So to overcome this problem, transfer pricing was introduced. What is transfer pricing? Transfer pricing refers to the rules and methods for pricing transactions between associated enterprise of multinational transactions. Its object is why it matters are profit allocation. It determines how the total profit of multinational group is distributed among its subsidiaries. Performance evaluation. It helps to identify how evaluation of performance between each individual. Tax efficiency. It helps in optimizing the global effective tax rate. It also helps in operational allocation control and cost management. Transfer pricing is a transaction between associated enterprises. So these are some of the conditions where if any enterprise falls under this condition, they are treated as associated enterprise. The first condition is that if one enterprise holds around 26% or more of voting power in other enterprise, it will be termed as associated enterprise. Similarly, if any person holding 26% or more of voting share powers in both enterprises, then it will be deemed associated enterprise. For example, if Mr. Ratan Tata sir holds a 30% share in TCS and 40% in Tata Motors, then the transaction between Tata Motors and TCS will also be termed as deemed associated enterprises. Next condition is that if any one enterprise appoints more than half of the board of directors or any one of full-time directors, then it will be termed as associated enterprise. Similarly, if one enterprise has advanced a loan of around 51% or more of the book value of fixed assets of the borrowing enterprise. For example, if one enterprise has given a loan of around 60 crores to B enterprise, so suppose A Limited has given 60 crores to B Limited. So B Limited, then suppose if the B Limited total value of fixed assets as per book value is 100 crores, then it will be termed as associated enterprise because 60 crores have been loaned given, so 51% or more. If one enterprise guarantees 10% or more of guarantee of the total borrowings to the other enterprise. Next, the business of one enterprise is wholly dependent on the know-how, patent technology. Suppose, for example, Kia Motors manufactures its cars in India. It uses the know-how of Hyundai Motors, so it is fully dependent on Hyundai Motors for its car manufacturing. So this transaction will be also termed as associated enterprise. Next, 90% or more of raw materials are supplied by one enterprise, then also it will be termed as if the supply are influenced by the supplier. International transaction. So, the transaction between associated enterprises of international transaction. International transaction means a transaction taking place between two or more associated enterprise. At least one must be a non-resident. Here the case is non-resident. Now I will explain the concept of deemed international transaction. Suppose A Limited and B Limited are associated enterprise, that is they hold 26% or more of voting power, and there is a prior agreement between B Limited and X Limited for the transaction taking place between A and X, then the transaction between these two is also termed as deemed international transaction because of this. Next, next let us know what is the arm's length principle. It is the pricing rules issued by Organization for Economic Cooperation and Development. It states that the price charged in a transaction by related party must be the same as the price charged to the unrelated or independent parties. Here are some of the methods for determining arm's length principle. First one is cup method, comparable uncontrolled price. It says that it compares the price charged in a controlled transaction with the price charged in an uncontrolled transaction. Let me give with an example. So Tata Components sells its steels to its UK subsidiary at rupees 80, whereas it also sells to an unrelated German buyer at rupees 100. Same product, same volume, same terms. Since Tata itself has an inidentical uncontrolled transaction with German buyer, so here the transaction with unrelated is independent is 100. So arm's length price will be 100. So it is helpful where market prices are easily observable. One more thing, cup method is useful. Suppose we have transaction with international, with related and unrelated parties, then such type of method is very helpful. Second one is resale price. Resale price, suppose starts with the resale price to an independent party and subtracts a gross margin. Suppose I am purchasing a procurement of raw materials from an associated person and selling it to an independent buyer. So here the cost of production will be not determined on the purchase value, but what I have resale the price minus gross profit margin will be my cost of production. So arm's length principle helps you. Next, cost plus method. Cost plus method, it adds as a markup value to the cost incurred by the supplier, commonly used for manufacturing and service provision. Here I am selling to my subsidiary company, but the sales value will not be declared on the value given to the associated enterprise. It will be calculated on the basis of cost of production from an independent party plus arm's length markup percent. Next, transactional net margin method. Here the profits earned by other players in the same industry or similar consideration is used for computing the arm's length principle. That is, arm's length principle is established when the tested party's net margin is easily comparable independent with net margin. One more important thing is while computing arm's length principle, if there is any reduction in profits or increase in loss, then arm's length principle is not applicable. And suppose if after the calculation of arm's length principle, our actual price and arm's length principle is less than 3%, then arm's length principle is not applicable. Actual price can be taken into consideration. Okay. Now the legal framework of transfer pricing. These are the OECD arm's length principle, other guidelines. After once the arm's length principle has been calculated and the amount is been ascertained, there are two adjustments: primary adjustment and secondary adjustment. Let us know one. In primary adjustment, if there is any increase in total income or reduction in loss, then primary adjustment must be made. Suppose we have sale to a foreign company at rupees 100, but actual arm's length price was 500. So here there is increase in total income of rupees 400. So this 400 must be repatriated, the excess money from foreign associated to India within 90 days. This is the first primary adjustment. It ensures compliance with arm's length principle. Secondary adjustment, if the excess amount from primary adjustment, that is 400 rupees, is not repatriated within the prescribed limit under Income Tax Act 1961, the repatriated amount is to be treated as deemed loan or advances to associated enterprise as per. So it will be treated as deemed loan or advances, and interest will be calculated on this deemed loan and becomes taxable in India until the amount is been repatriated. Thank you.